We do have to talk about expected prices, and so I'm going to talk a little bit about what it looks like this fall, and also what it looks like in the fall of 2022. Looking ahead at 2022, and so that'll be the focus of this presentation. As is indicated here, I've got several different topics I want to talk about. At the Center for Commercial Agriculture, I'm primarily responsible for delivering programs related to farm management, and so I spend a lot of time looking at net return projections, talking about budgets, and also looking at cash rents and land values, and so that's why I'm focusing a little bit heavier than Chris Hurt would have back in the day on crop prices. So I want to start by talking about the Ag Economy Barometer. That's the sentiment index that the Center for Commercial Agriculture is responsible for. It's a monthly sentiment index, and so it kind of gives a read on what people are thinking across the United States regarding production agriculture. And so I've got a couple slides on that. And then I'll talk about expected crop prices, talk about net returns, and then finally get into discussion of cash rents and land values. Before I forget, we do have a webinar at 12:30 on Friday at the Center for Commercial Agriculture related to cash rents and land values. And so if you have not signed up for that, you can do that on the Center for Commercial Agriculture website. So start with the Ag Economy Barometer. Just to give you a little background about the individuals that we survey. We survey 400 U.S. agriculture producers across the United States that grow or produce these following enterprises. And so corn and soybeans makes up over 50% of those that are surveyed, but we also have wheat, cotton, beef, swine, and dairy. This roughly represents the value added in U.S. agriculture. And that's why corn and soybeans has a heavier weight, because corn and soybeans is responsible for a large proportion of the value added in the United States. And just remember, this is the United States, a U.S. survey. It's not just Indiana. And so the respondents also have a gross income over $500,000. The reason why that's important is their full-time operations. Only 10% of all U.S. farms are full-time operations. And so that's why that's important. We want to make sure we're talking to the people that are in production agriculture as a business and are in it full-time. We do not survey the same people every month. That would be impossible to do, because we'd call people back and they would say, "Oh, that's those Purdue people again." And so we do keep the characteristics the same, but it's not the same people. So one of the things that we ask on the Ag Economy Barometer is we ask an open-ended question at the end. What's on people's mind? I have a lot of relatives in agriculture, and they're not shy about telling you what's on their mind, and so the same is true in this survey. And so this is kind of a summary of the different things they talked about in mid-July. There's a lot of different things that are important there, and this helps explain why the sentiment is down the last couple months, because there's some things there that are not necessarily positive. Certainly crop prices have been relatively strong, but they have been dropping. If you look at the nearby futures, we've lost quite a bit of ground since May, and so that's certainly on people's mind. But also taxes. There's a lot of potential tax changes, including estate planning tax changes that are important. Politics. Inflation. I'm not going to show some slides related to inflation, but historically, prices paid index for U.S. agriculture, if you look at the last 10 years, has increased less than 2% per year. So that's the last 10 years. Guess what? Inflation is picking up. It's not just fertilizer, though fertilizer is one of the largest increases we've seen. It's a lot of different input prices. And so inflation is certainly on people's mind, along with regulation and several other things. So with that, that's a good lead into the actual Ag Economy Barometer. Of course, higher means they're more optimistic, lower means they're more pessimistic. Last summer, people were very pessimistic. We had $3 corn and below $3 corn, so why would you expect anything different? As the corn prices and soybean prices started picking up, along with some other commodity prices, the sentiment increased, but it's dropped here the last 2 or 3 months, and I think a large part of that is the uncertainty related to politics. particularly the tax, the estate tax issues and regulations and some of those kinds of things I think are playing on people's mind. But it's also the drop in nearby futures prices. Corn certainly is much lower than what it was in May, as well as soybeans. And so I think that's played into the sentiment. We're still relatively strong compared to most of the period here, but nevertheless the sentiment is lower than what it was earlier this year. And that's true both for the sub-indices, index of current conditions, which tries to explain what's going on currently in the next year, and future expectations, which is looking at 5 years from 5 years in a row. And you can see here, because 21 is probably going to be a pretty good net return year, the current conditions is above the future expectations. That's not real surprising given that 21 is going to be a pretty good year. But what about 22? I'm going to talk about that. What I think 22 may look like from a net return standpoint. So let's talk about crop prices. First of all, when we look at the August crop report, there's a couple things here that are very important. First of all, the Eastern Corn Belt is looking at some record corn yields, record soybean yields too. So Illinois, Indiana, Ohio, we're looking at record yields. In Indiana, it was 193. That would be a record corn yield if that comes to fruition. Right now, about 70% of the corn crop is rated good to excellent in the latest report. That's running considerably above the 5-year average. So that's certainly a good sign. But the other big story here is how low the yields really are in North Dakota, South Dakota, and Minnesota. If you look at crop conditions report in those 3 states, they are extremely low compared to 5-year averages for those states. I think Minnesota and South Dakota is around 30% good to excellent, 30%. And North Dakota is like 20% for both corn and soybeans. And so things look really grim out there. Why is that important? Well, those 2 regions are responsible for about 20% of the corn production and over 20% of the U.S. soybean production. So what happens in those states really, really matters. And so that helps explain why the corn yield, the U.S. corn yield was lower. It was quite a bit lower than the initial estimate earlier in the year, which was based on trend yields, partly because of those very poor conditions in North Dakota, South Dakota, and Minnesota. Wisconsin's also not real good, and so it's kind of a 2 worlds, if you will. Some very good corn yields and some not so good corn yields. Looking at the balance sheet, just a couple things I want to mention here. One of the things, and we talked about this in our webinar last Friday, in case you tuned into that. We have a monthly webinar approximately in the middle of the month, it's something you can watch on YouTube too. You can watch the YouTube and see if my discussion today differs from Jim Minnert's, and just tell Jim he was wrong. If you know Jim. But it's interesting, the average market price for corn, looking at the next marketing year, is $5.75. That's more optimistic than the futures market. So that's real curious. But why is the corn price relatively strong for next year? Well, several of the things that have been going on the last several months are expected to continue into the next year. Some strong demand for feed, some fairly strong demand for ethanol, stronger than last year. Not quite as strong as what we saw 3-4 years ago, but still relatively strong. If you look at exports are a little bit lower than the last year, but considerably higher than what we saw 2-3 years ago. And so there's some very positive signs on the demand side for corn, helping support that price well above $5. And so that's a very important story, because for most people, I'll show you some break-evens later, for most people that's considerably above break-even. And so 22 is not going to be as good as 21, but it's still shaping up to be a pretty good year, perhaps comparable to 2020 in terms of net returns. Looking at the futures prices, this just shows you that there was some opportunity. This is December contract. There was some opportunities earlier this summer for some pricing above $6. You have to adjust for basis, of course. Now we're looking more in that $5.50 range, but still really good compared to what we were earlier in the year. And so if you looked at the nearby futures, the decline from May to the current period would be larger drop. And again, that's responsible, I think, largely for that drop in sentiment that we're seeing in the Ag Economy Barometer Index. Turning to soybeans, a very similar story to corn with one caveat. There's one difference in soybeans compared to corn, but a couple things that are the same: very strong yields in the eastern corn belt, looking at record yield in Indiana. If this comes to fruition at 60 bushels, the previous record was closer to 58. And so that would be quite a bit above the previous record. 64 bushel average in Illinois. 64 bushel average. I mean, we all know that there's fields out there with 70, 75, 80 bushel soybeans, but to have an average of 64 bushel, incredible. And some really good soybeans in the eastern corn belt, really poor conditions in North Dakota, South Dakota, and Minnesota, and they're about 22-23% of total U.S. soybean production. It's just incredible how much soybeans are produced in the Dakotas today compared to even 10 years ago. And so when you look at the U.S. yield, it's not down as much as corn. It's slightly below trend, but only slightly below trend. As I said on last week's webinar, I think there's some downside potential in the U.S. soybean yield because of those very poor conditions up in the northern plains. Having said that, if they got some timely rains, maybe the crop conditions would improve slightly. And you know how resilient soybeans are. If you get some key rains when they're setting pods, even bad-looking soybeans can do better than you thought they were going to do. And so quite a bit of uncertainty related to the U.S. soybean yield. And so that could change rather dramatically in the next crop production report. Looking at the balance sheet, some very positive signs again. It looks like the crush is going to be very strong again this next year. Also, exports look like they're going to be very strong this next year. Not as strong as what they were this last year, but still very strong compared to historically where those exports are going to be. Of course, a lot of the exports are to China. And so if China shuts the faucet off, which we don't expect them to, but if they did, that would change rather dramatically. Brazil continues to increase soybeans, but quite frankly, even if Brazil continues to increase soybeans, the U.S. is still very well positioned to export soybeans because the production of soybeans is very, very concentrated. I don't know if you've seen those numbers, but about 75 to 80% of soybeans are produced in the U.S., Brazil, and Argentina. And so if Brazil sends more soybeans to China, there is other markets out there to send U.S. soybeans. Looking at soybeans, it looks like it's similar to the corn, but a larger drop in the November contract. As we had fairly high prices in May and June, it's dropped off some, and now we're about $13.50 looking at the December contract. Still, that's well above most people's break-even price, and so we'll talk about what that might look like going into 22. But at least for this fall, it looks like we're going to have some pretty good prices, some pretty good returns for the soybeans, particularly in Indiana with those really strong yields. Hopefully everybody in here has some fields that are very strong yields. It looks like it's going to be a pretty good year. I've got two of these charts. One is for the fall of 2021. The next one is for the fall of 2022, and so this is fall of 2021. And one of the things that I use to kind of gauge band around the futures price, I encourage producers in agribusinesses and other folks to use this same tool. It's something from the University of Illinois called iFarm Price Distribution Tool. And what this does is it uses option prices to come up with a band of potential futures prices. They only do it for corn and soybeans. And so my friends in Kansas, I spent 20 plus years working in Kansas. There's no wheat, but certainly good information for corn and soybeans, so important for Indiana here. And it shows the midpoint corn price for December, $5.63. It's been running that $5.40 to $5.60 for quite some time, as I showed you on the chart. But there is some potential. There's a 25% chance that it could be as low as $5.10. That's still a good price, compared to break-evens. But there's a 25% chance it could be over $6.22. So that makes marketing really difficult, but I'll repeat an adage that my father used to tell my brother-in-law that had trouble selling his soybeans for a profit. You can't lose the farm by selling at a profit. And so think about pricing some of your corn and soybeans if you haven't done so already, because these are pretty good prices. There is some downside if the yields are better than expected in the northern plains and in the U.S. Those prices would drop a little bit. There's also the uncertainty related to corn imports from China. They've been importing quite a bit of corn, but that's not a guarantee that that's going to continue into the next 1 or 2 years, and so there is some potential downside there. I think there's a little less downside on soybeans. I'm a little bit more optimistic with soybeans simply because the stocks to use is so low. We're at like 3% stocks to use. There's only been a couple times in the last 20 years we've been that low, and so there's just not that many soybeans out there. But the midpoint price, $13.65, 25% chance of being below $12.87. Again, that's quite a bit above most people's break even, and then there is a chance that they could be above $14.50. Could be similar to some of what we saw earlier this summer. Let's look at 2022. These are lower, obviously. But it's surprising that they're not even lower than what I'm presenting on this screen. Why do I say that? Well, our break-even prices have certainly increased. I mean, for a lot of people, you look at 2022 budget. Hopefully you're working on your 2022 budget or have already done that. The break-even price for corn is substantially higher than what it was last year, fertilizer, seed, but also cash rent. Cash rent is up about 5%, and it's probably likely to go up in 22 again. I'll talk about that later in this presentation. But it's still, for a lot of people, it's $4.50, around $4.50. So you look at that $5 price, even adjusted for basis, you're still looking at something above break even for corn. If you look at soybeans, the break-even price has climbed from about 10 to maybe 10.75, 10.50, 10.75. But even adjusted for basis, we're still looking at a pretty good soybean price for 2022. And so 2022, not as good as 2021, but 2022 looks pretty good. That's why we're seeing this upward pressure on cash rent is because of what's going on here. There's also, of course, a chance that those prices are going to be at or below break even. That's always the case, but there's also a chance where prices could be really high. So a lot of uncertainty right now. We're looking a long ways ahead when you're looking at December 22 futures and November 22 futures, but I just wanted to talk a little bit about what the prospect was for the 22 crop. It's certainly not a repeat of the 14 to 19 period at this time. Notice how I said that? You always got to have a lot of caveats when you're up here. I don't have enough hands to say on one hand, on this hand, on one toe, on this other toe. I mean, there's just a lot of uncertainty right now. But if you're making long-term decisions, I think this is a good way to think about it, is to look at these long-run prices and make decisions accordingly. Before I leave the expected prices, just one comment on acreage. This is trend in corn acres in the blue, soybeans in the orange, and wheat in the gray. And obviously, wheat is eroded market share over time. We'll see what happens next year. Wheat is more short. There's more shortage of wheat this year than we thought there was going to be because the spring wheat is absolutely atrocious up in the Dakotas. And so maybe the wheat acreage will tick up a little bit, but that's really not where the play is for corn and soybeans. Corn and soybeans are going to compete against one another. We saw that large drop in 19 because the prevented planted acres to a large degree, but also the trade dispute with China. We remember that. I probably shouldn't even mention it. Because we do remember that. Soybean prices were weaker. Because of that, we had a large increase in soybean acreage in 21. There's a lot of demand for both corn and soybeans, and so they're going to be competing for acres as we look at 22. One of the things I'm going to do here later in the presentation is stick my neck out a little bit and look at relative returns for corn and soybeans looking at 22. I'm hoping nobody takes a picture of that and brings it to me early in 22 and says, look, this isn't even close. Well, I update that on a weekly basis, or at least a monthly basis, and so check back with me. I'll have new estimates. Net return projections. Let me start with talking about break-even prices. This is on high productivity soil. As you go to average productivity soil, the break-evens are higher than this. And so you're looking at break-even even on high productivity soil. I looked at some budgets in Illinois also. My good friend Gary Schnitke put together, and we're looking at a break-even for corn 430 to 450. Kind of grabs it. That's kind of a low number. There is going to be some break-evens that are higher than that, particularly on more marginal soil. Soybeans has went from about below $10 up to about $10.50 to $10.75. Gary Schnitke's budget for soybeans were a little lower than that. They were more like $10.25. But putting the numbers in, the Purdue budgets, I'm more like $10.75, $10.50 to $10.75, and so certainly because of the cost pressure, particularly with fertilizer, we're seeing some increases in the break-even. But the main reason I'm showing this is you relate those back to those expected prices. It still looks pretty good. These break-evens are lower than the expected prices for 22, even adjusted for a normal basis, if there is such a critter. Let's look at the long-run moving average of break-even prices. I get a little carried away with this one. If you haven't heard me speak before, I love talking about budgets, and so I couldn't help myself. So I grabbed a couple slides here looking at moving average cost of production for a case farm in west central Indiana. The bars are 5 years, and the 10-year is green. Let's focus on the 5 years. We did a really nice job from about 14, 15 to 21, reducing that break even. We were down in this case, we weren't below $4, but in some cases we were below $4 on high productivity soil from a break even standpoint. So at least a 50-cent reduction. What was the cause of that that reduction in break even prices? Two things. Fertilizer was lower. It's not lower than this next year, but it was lower for a period there compared to 2013, 2014, so that was part of it. But what was the big one? Cash rent. We saw a fairly large reduction in cash rent across the state, 15 to 20%. Well, guess what? Fertilizer costs are back where they were 2013, 2014, depending on when you look at them. But the latest report I got from Illinois, fertilizer report, published by USDA, they were back to the levels 2013, 2014, and cash rent looks like it's creeping back up. And so all I'm showing you here is the break-even price is likely to increase, moving towards that 450 long term. One of the reasons why I cover this is sometimes people ask me, what do you think the long-run corn price is going to be? Well, I look at break-even prices. If the long-run break-even price is 450, that's your best bet 2, 3, 4 years out what the corn price is going to be. Soybean prices, a similar story. We dropped soybean prices rather dramatically, 75 cents, dollar, even more than that. Looking at $14.50 in terms of reduction in soybean prices, but they are going back up. Soybean break-evens are even more sensitive to changes in cash rent. Approximately 40% of the cost of producing soybeans is cash rent. And so if cash rent goes up, soybean break-evens go up even more. And so they're more volatile than break-even prices for corn because of the heavy land cost associated with soybeans. Well, why is that the case? Well, seed cost is cheaper, fertilizer is cheaper, and so a lot of the costs that are very important for corn are cheaper for soybeans. And so if you're using the same cash rent, by definition, land's going to be more important for soybean break-even price. And so soybean break-even price is increasing, again, probably moving towards that 1050, 1075. And so when we look out 2, 3 years from now, that's where you expect soybean prices to level off at. We're still not back to that in 22. Why? because the stocks to use is so tight. And we have a lot of demand in terms of exporting soybeans from the United States. And so because of that, it's going to take a while to work through that situation, that very tight stocks to use. It takes time for the U.S. to respond. It also takes time for our partners around the world to respond. So for the next year or two, we're looking at a situation where we're above break-even price. Looking at, this is my case farm again, looking at net farm income per acre, just to illustrate how good 21 is shaping up to be. 21 is that very large bar towards your right. It rivals, if not exceeds, what we saw in 10, 11, 12. And that's with no government payments. And so 21 is shaping up to be a really good year. Just showing you this chart explains why cash rent's up 5% and land's up 14%. You see something like this, you see that a huge increase in liquidity. I'd be shocked if there wasn't large increases in cash rents and land. Also, another factor that's helping that surge in cash rent and land prices is inflation. Inflation, like I said, is running about 2% for the last 2 years before 21. It's closer to 5-6%. Now, there's a certain administration said this is going to be short term. I think that's an open question. Whether this inflation is going to be short term, 5-6%, or whether that's going to last a while. And so that's also creating a situation where there's a little bit of uncertainty going forward. But the inflation certainly would help the land market. I've done some research related to this. Land's probably a better hedge against inflation than gold. Typically they talk about gold as a hedge against inflation. I think land's even better. And so there could be some more outside money if that inflation continues, driving up land values in particular. 22 looks like it's going to be similar to 20, quite a bit above what it was from 14 to 19, and close to the average since 2007. The reason why I started with 2007 is that's the start of the ethanol boom. It doesn't make any sense to go before that because that really was a different world, if you will. So pretty good expected returns in 22. Looking at the corn versus soybeans, I promised this. It looks like in 21, if the yields hold, according to the August crop report, that corn's going to be more profitable than soybeans, and it's going to be the most profitable it's been compared to soybeans since 2012. And so certainly a different situation for corn this year than we've seen for a long time. We went through that extended period where soybeans were more profitable than corn. So in terms of competing for acres, corn's going to do its darndest to try to outcompete soybeans for acres, particularly in the eastern corn belt. But I think this is probably even more extreme back in the western corn belt. I'm from Nebraska. I think this bar would actually look larger. This green bar would actually be higher in Nebraska and Iowa because their corn yields are better than ours, and their soybean yields are similar. So corn's going to be very competitive. Moving into next year. Looking at next year, Indiana, there's a slight advantage towards corn, but quite frankly, when I update this, I get carried away with this slide in particular. I update this weekly, if not bi-weekly. It bounces around. Slight advantage corn, slight advantage soybeans. Slight advantage corn, slight advantage soybeans. And so if you were trying to guess the acreage for next year, I'd keep it about where it was this year. Profitability, cash rents, and land values. Oh, I'm doing good on time, no problem. So let's take a close look at this. I'm going to summarize some information from the 2021 Purdue Cash Rent and Land Value Survey. I'm just going to show averages for the state. As you know, there is information by region in Indiana. We'll share more of that on Friday's webinar. So please tune in to that. But looking at top, average, and poor, the cash rate increase was about 4 to 5%. What do you think it's going to be for next year? Higher, lower? Does anybody think higher? That's where I would vote. I think 5% could be a relatively low increase for next year. Why? Well, go back to that 21 income. When there's pretty strong income in the previous year, we tend to bid up cash rent in the next year. And so because the income looks fairly strong for 21, that puts quite a bit of upward pressure for 22. But I also think the increase in production costs, the inflation in general also is causing a situation where there's going to be upward pressure for cash rent. And so if you had to pin me down in terms of increases to expect for next year, I think anywhere from 5 to 10% is where I would place that. I know that's a very wide band, but that's much higher than what we saw the last few years. Now there was, let me get my glasses on to make sure I get these numbers right. Since 2007, there's been 3 years where cash rent, I'm looking at West Central Indiana because that's where my case farm is from. There's been 3 years where cash rent has been, the increase has been larger than double digit. 2011, 16%. 2012, 15%. 2013, 11%. One of the things to think about when you're thinking about several years in a row of relatively large cash rents is, let me go back to this slide. To see multiple years and large increases in cash rent, we really need several years in a row of very strong net income. One of the reasons why I'm not expecting double digit, though it certainly could be, I'm not expecting double digit increases in cash rent, is that the situation today is not the same as what we saw in 10, 11, 12. We're not going to see 3 years in a row, at least I don't think we're going to see 3 years in a row where net income per acre is substantially above the average. We're looking more at 1 year and then dropping to that average. And so I think that puts some cap on the potential increases in cash rent. But if I saw 9%, I would not be surprised for next year. I think because there's quite a bit of net income out there, I think there is a very definite chance of some increases in cash rent. One of the things that the Purdue report does that's very, very useful is not only talks about rates per acre, it talks about rates per bushel. So please take a look at that, because if you look at the report, it talks about the corn yield associated with the different types of land. So for the state, 153 bushel for poor, that's mostly southeast, 182 for average, that's every district except for West Central and Central. And in the top 212, a lot of that's in West Central and Central. But it gives you the corn yield along with the value per acre, and so it gives you that cost per bushel. And so if you had a 5-year average corn price of 200, you can use that cost per bushel to figure out what the survey is saying about your cash rent. And so that's very, very useful to keep that in mind when you're looking at that report. For this year, looking at the average cost per bushel, it was $1.25. I actually think that's going to increase. It's going to be closer to what it was a few years ago, maybe $1.30 per bushel. And so that's kind of the rule of thumb I would be using, $1.30, $1.35, somewhere in there, looking at the 22 cash rent. This didn't surprise me that much. I'm on record someplace saying 5% for 21, so that didn't surprise me very much. This one did. But there's a lot of factors of why this is the case, and I'll show that on the next diagram. I thought the increases would be slightly lower than this. When you look at land values, let's take a look at that. It was obviously 12.5% for average, and I think in West Central it was closer to 14% for the average, so it did vary a little bit by area. If we look at West Central Indiana again, now we're looking at several years where we had increases that were double digit. So 2007, 15%, 2008, 13%, 2011, 22%, 18% in 12 and 13, and then 14% in 21. And so it's relatively more common to see land increase in double digits than it is cash rent, at least since 2007. Why is that the case? Why do you think that's the case? That's not necessarily a rhetorical question. Where's Catherine? Newton County, she should know. Why do you think that's the case? That there's been more upward pressure on land values than cash rent since 2007. Land values is driven by cash rent, or net return to land, but also other factors such as interest rate. And so the interest rate has been very low since 2007. That's contributed to these very large increases in land values. I mentioned the years, several years since 2007, and again in 21, it's that low interest rate. If something would change related to interest rates, so this is what you want to watch for land values, if something would change related to interest rates, and I'm not thinking it's going to anytime soon, at least over the next year, but if the Fed for some reason decided to increase interest rates, then land values would react in a very negative fashion, because they've increased because of the low interest rates. If interest rates go up, there would be pressure for land values to go down, and there would be pretty strong pressure. Interest rates are an extremely important factor when you're looking at land values, whether that be outside investors or farmers bidding for ground. Extremely important what that mortgage rate is in terms of land values. Just a couple other things on land. Holding land has two returns. One is the cash rent. That's been increasing since 73. That's increased 5% per year. So that's been the average. It's closer to 3% now if you look at cash rent to land value. But from 73 to today, it's about 5%. So that's one component of the return for land value. The other is appreciation. The appreciation for land values, this is the average from 73 to today, is over 5%. And so you add those two together, the rate of return for land since 73 has been 10%. How does that compare to the stock market? Well, it's lower than the stock market, but guess what? I'm trying to explain why outside investors are interested in land. This isn't going to go away anytime soon. The return for land has been 10%. It's higher than the stock market, but guess what? Land's had some hiccups. There's several in here as old, if not older than me, that remember the run up in the 70s, and then it came down. So the correction in the 80s. Also recently, we saw that run up from 2007 to 2013, and then we had a correction, not as deep as what we saw in the 80s. We saw a correction from 14 to 19. So we have had some hiccups, but think about the stock market. If you've had money in a 401k like myself, I lost the shirt off my back, almost, in late 1990s when the tech bubble busted. You know, I'm holding for the long run, so I didn't pull out. I was still a younger man at that time. And then in 2008. And those crashes were big. These weren't 5% reductions. They were big changes, even compared to land values. And so the stock market is considerably more variable, so that makes land attractive. The other thing that makes land attractive, and my colleague Todd Keithy has an article in the Purdue Ag Econ report that appears alongside this cash rent and land value article that compares rates of return for gold, bonds, stocks, and it also looks at the relationship between the returns for those. Guess what? Land values are not related to stock prices. And so some of this investing in assets, pension funds, for example, because land you have to hold. You can't get in and out of land or you're going to just get, you're going to lose every shirt in your closet. You just can't do that because it's too costly. But if you're willing to buy and hold, like some pension companies are, the fact that those two are not correlated, that there's no close relationship between increases in land values and increases in stock value, they don't move in the same direction, makes land very attractive to outside investors. And so as long as interest rates stay relatively low, the land market's going to stay relatively hot. Also, inflation is helping the land market, as I indicated before. And so there's some very positive signals related to land prices in the next year or two. This is a busy slide. I attempted to not put it in, but then if I didn't put it in, I would forget to talk about it, and that would be a shame. That would be a big shame. When you look at factors that explain land values, it's net income, The 2021 is the black bar. So obviously the strong net income of 21 was very important to explain the double-digit land values. Crop prices, that's related to the net income, of course. The other thing here was the growth in returns. Returns have been fairly good related to land prices. Look at interest rate. Interest rate was relatively high, so there's no negatives. Exports were good. Inflation is positive to land values. Liquidity. We lost quite a bit of liquidity from 14 to 19 in the agriculture sector. We've gained quite a bit of that back in 20 and 21. So the fact that we had more cash available also put upward pressure on land values. And so if you go through that list, there's not quite as much impetus from net income. Net income is going to be a little bit lower, but it's not going to crash. Interest rate is probably not going to change that much, and so it's not going to be a negative factor. Exports look relatively strong for production agriculture, so that's not a negative factor. Inflation is probably going to be higher than that long-term average of 2%, so that's not a negative factor. And liquidity is going to probably remain strong, relatively strong, because net income is going to remain relatively strong. And so there's a lot of positive factors pertaining to land values. Now, if I would give a presentation like this 4 years ago, it would have been completely opposite. At that time, there was a lot of negative factors related to land values. Now, there's a lot of positive factors related to land values. This just shows you the average cash rent to land value. This has changed dramatically. In my lifetime, I don't go far enough back. Many of us remember the 70s. I probably should have put that in there too. But the average is about 5%, even go back to 73. But it's a lot lower today, and so some people say, man, my land values went up and my cash rent is it's not as big compared to land values as it used to be. It's only 3%. Well, is that your real rate of return for owning land if you're a landowner? No. You also have to think about appreciation. Appreciation's been relatively high since 2007, and so I'll stand by that statement that over a long period of time that the rate of return for land has been closer to 9-10%. So pretty strong return for owning land. I recently inherited a piece. It's not very big, but I'm renting it to my brother. Market cash rent. I can't believe it when he told me he's going to pay market cash rent. About fell off my chair. But he's paying me market cash rent, and I'm holding. So I'm very, very positive on production agriculture, very positive on land because of that. Just a few more slides to kind of talk a little bit about this increase in potential cash rent coming in 22, perhaps 23. This just shows a little different way. Rather than using net income, I'm using net return to land, so all costs are subtracted except for cash rent, and then I have cash rent. And in cash rent, when you see these large increases over time, you look for periods when net return to land is relatively high for several years in a row, i.e. 7 to 13. We went in west central Indiana from something close to 180 all the way up to close to 300 because we had this very high net return to land. If we look at 20, 21, and 22, looks a little more positive than the net income graph because it's not measuring exactly the same thing. We're looking at a situation where we're also seeing several years in a row where cash rent's higher than net return to land. And so 5% in 21, 5 to 10% in 22, it's probably not over in 23. And so if you're out there looking at cash rent, this is just what you're going to have to live with because when you see several years in a row like that, particularly 21, you would expect some upward pressure for cash rent. Of course, over the long run, cash rent, these two will equal. And so if you looked at this over a long period of time, the average net return to land would be about the same as the average cash rent. That's what we call equilibrium. Many of you guys took economics, and probably that was your favorite course, probably, and that's what we called equilibrium. Just a little bit more on the barometer. Let me check my time again. I don't want Phil to get angry with me. I've got a few more minutes, right, Phil? Let's see him. Yeah. So let's just two or three more slides to talk about go back to the Ag Economy Barometer. So not what Langemeier thinks. Let's go back to what the people we survey in the Ag Economy Barometer think about financial conditions and land values. And so I'll finish with two or three slides from the Ag Economy Barometer. And so we've been surveying people for quite some time related to farm finance. And so what does their financial situation look like 12 months ahead? And so we were running really strong here from early 21 till about May or so. And then it dropped down. And you say, well, why did it drop down? Remember, the way this question is asked, they started looking at 22. And so the nearby futures prices were dropping, and so they thought, all they're saying is they think 22 is not going to be as good as 21. No more complicated than that. And so that's essentially what's happening in terms of farm financial performance. It's still extremely strong compared to what we were in the summer of 2020 and before that, where things always look worse. It always looked like the next 12 months is going to be worse. Looking at farmland prices 12 months ahead, this varies quite a bit too, and it really follows the sentiment index very closely. So the Ag Economy Barometer index has dropped the last 2 or 3 months. The sentiment has dropped here slightly, but I think this group is probably a little bit too pessimistic. Only 50% think that farmland prices are going to be higher 12 months from now. Now, granted, some of those people could be in the Great Plains where there's not as much pressure. If you're farming in North Dakota and you're seeing that terrible looking crop, you're not going to expect cash rent to increase. And so there is a swath of the U.S. where they're probably not going to have much pressure. But I think in general, if you look across the Corn Belt, I would be just shocked if we don't see an increase in land values in the next 12 months. And sure enough, there's not very many that think they're going to decline. I think, being a little bit flippant here, I think this is wishful thinking. Now, perhaps they're going to decline. People think they're going to decline, and they're going to be able to buy land. I just can't paint a scenario where that's necessarily going to happen. Let's look further ahead. Farmland price expectations 5 years from now. And this is overwhelmingly positive, as you'd expect it to be. 60 to 65% think they're going to be higher 5 years from now. I'm certainly in that camp. And then a very small percent think they're going to be lower. And so this tells you, even though the sentiment index has dropped, they're still relatively optimistic about the long-run prospects in production agriculture, because the vast majority are thinking that farmland prices are going to increase in the next 5 years. How common is it for land values to not increase during a 5-year period? Does anybody have a feel for that? Didn't see anybody from Holterman here. Perhaps they're here. It's rare. And so this 9% here, they're thinking a repeat of something like the 80s or that 2014 to 2019 period. There's only been a couple times in my lifetime, I was born in 61, there's only been a couple times in my lifetime where we've not seen land values increase over a 5-year period. There was 2 or 3 years in a row in 1980s. Land values declined dramatically, of course, and so those 5-year averages were negative for 2-3 years in a row. And then in 14 and 19, there was a period, I think it was 18 or 19, perhaps 19, where in Indiana, the 5-year period was slightly negative, but that's fairly rare. And so this is not this is not rocket science that a large percent think that they're going to increase. We didn't ask them how much. Perhaps we should. That's probably all over the board. There's probably some think they're going to increase just barely, some think they're going to increase rather dramatically. So that's what I wanted to discuss today.